Good afternoon, traders. Today is the 12th of October 2016. Welcome to FreeFX, the free resource for educational purposes. The logo is not displaying here. I've had a problem with my Google account, so this is linked to the Google account, so apologies about that. Here's a disclaimer, just a standard disclaimer to say that all information here is for educational purposes, not for trading advice, and protect yourselves from risk. And there's my name there. So I'm Francesco, and this is the 51st video of my FreeFX channel on YouTube. This is the topic of the day, which is when is it time to admit defeat? And of course, this is something that everybody has to ask themselves at some point in a trading career. If we don't want to admit defeat, then perhaps we can call it something like take a step back and observe and reflect. So for this purpose, I thought I would show you my FX book. If you haven't used this service, it is very useful for displaying your trading data and so on. I really want to show you this because it has been a fantastic resource for me to look back on trades and really kind of get a sense of my progression or my regression. In this case, it's the latter. Now, in July, you may recall my previous video was my year in the markets. This video is obviously a few months later, and not much has happened since July because the EU referendum in the United Kingdom took place in June on the 23rd. So my July video had already looked at a month or a few weeks after the referendum. And this really then deals particularly with the collapse of my trading account due to a single event which happened on the night between Thursday last week and Friday, which was a British pound led movement in price in the markets. And really I couldn't stress enough how unforeseen the event was. There have been many reports on this. Everybody's wanting to say their piece about what happened. And clearly this is great because it is talked about and it kind of makes you realize that it was quite a big event which many of us could not prepare for. So in a way it softens the blow because I planned for many scenarios, including the UK referendum. And that really was something that I thought I dealt with reasonably well. I mean, I capitalized enough to meet the increased margin requirements from my broker and more. And certainly I capitalized enough for me for what I planned to capitalize on the account. So really, and try to sort of add the odd short-term trade to hedge or maybe reduce my exposure overall. But what I couldn't foresee, really, what I couldn't really predict, nobody can predict the markets. This event, however, is one of those black swans, if you want to call them that, or some call it a flash crash. But you can see here on the red curve, that's the balance and then equity sort of collapsing. What's significant about this is that my exposure at the time was particularly great. So I mean, if you look at the history of my trades, these are the trades that were closed down. Basically, you can see that I was depositing money up to August and September. Now October had just started, and I did wonder whether I should deposit money, but I hadn't quite done that, made that step of deciding how much or when, because the EU referendum had passed and really the hysteria had passed, and I felt that I was coping well just hanging on to my trades. What's interesting here, this area shows all the past trades, and you can see all the details. The longest trade I had was the euro pound for 447 days. Okay, that trade, including everything, so the net profit, including the negative swap and everything, was a whopping £213 loss. And surprisingly, it wasn't really as big a loss as I thought, but the best loser, if you like, of the day was my pound Kiwi, £497. I mean, that was pretty much half of my account. By this point, my account was about £1,028. The height was 1,035 anyway, so a few days of negative swap had sort of reduced it to 1,028. So this is basically a bit less than half, but a big chunk taken off. Then, if that weren't enough, all these other trades were taken off in a sort of snowball effect. So really massive loss. Now, if you take the this trade here, £497, that really means that this trade alone was, close to 50% of my overall balance. Okay, if you talk about equity, then it's a different thing. But in terms of the overall balance, this was about 50%, and then you can add all of these, and so I was pretty much exposed a fair bit when you add all of these trades together. It was quite a significant amount, and before the event, I was exposed by about 12,000 pips in the red, and that's a huge amount. Since my July video, that increased, and then it sort of came down to 11,500 and a bit less, and then increased again. So it was kind of fluctuating, but every time it was fluctuating down, and then it sort of fluctuated back up, and it sort of went higher. And the 12,000 mark, the highest exposure I had was minus 12,000, I believe 350 pips at some point. And I tried to keep tabs on these things so that I knew the highest exposure, or the height of my drawdown, and that helped me calculate my targets. And this is my next point. Okay, so just to summarize, the point at which I should have cut off was shifted every time. So that when I got to 10,000 pips, I'd sort of made a calculation as to how much that would be spread across the different trades in terms of my targets. And eventually the 12,000 pips mark came along, and I started really thinking that the targets were getting bigger and bigger. So the FTSE 100 was about 1,000 points, or 1,100, and then the pound Kiwi was about 6,900 points or pips, and so on. So you can see kind of how I was planning this to go ahead. But I also realized that when you do that, when you shift the parameters without stop loss, obviously you're just letting a trade breathe, and the targets get bigger and bigger. So you might start sort of appreciating that you may not get the targets. So for example, on the pound Kiwi, I was prepared to have a negative reward to risk ratio, because a 1-to-1 would have meant something like 3.11. So I was prepared to get up to 3.0 as a price. Okay, so 3 Kiwi dollars per pound. But obviously that at the moment is quite a high target anyway, so that's really something to consider when you let the drawdown increase. Your targets also, if you're going for at least 1-to-1, need to increase. And I haven't talked about 2-to-1, 3-to-1 risk reward ratio, because that would be a huge amount in terms of these kind of moves. 6,000 pips, that means you'd want to aim for 12,000 pips, and that's a huge amount. It could take years. And I was really aiming to have these trades closed within a year, and then, as I said, in July, maybe roll on to 2 years. But as I said before, these are long-term trades, and it's quite difficult to know how long you'll be in them. However, I was talking to a hedge fund manager who came on to a show called Chat with Traders, and I really thought that he had a point, because I told him a few weeks ago that this was my situation, and he said that you could see a problem here, and the main problem is that I didn't have a system in my discretionary approach where there would be some sort of rule or sort of threshold or some kind of signal or some kind of pointer where I would know that my target was breached, so that my trade was in the wrong, and that I would basically have to just give it up, cut it off, cut my loss. And that's true, because without a stop loss in place, you have to have that. Otherwise, there's no way to stop the trade if you don't yourself intervene and have a way of assessing that, not just emotionally or sort of in a gut instinct kind of way, but really have a commensurable way. So this is the next point, point 3 of my video, and I'm going to finish here, which is when do you admit defeat? So when you've reached a certain point, and you should probably say, okay, I'm going to cut off this trade. If you don't do that, something like this might happen. So I was unfortunate enough to be hit by this event. The pound alone dropped 800 pips during the night, and as some people have pointed out, some brokers had a sort of black hole where there was no kind of no liquidity. Almost there was a sort of a gap, and then this sort of huge event basically swept through price like pins at a 10-pin bowling alley. So just knocked the price around, and this has left me kind of severely wounded in terms of the account being blown away completely. And I've lost all my money. I sort of got in touch with my broker. Unfortunately, at the same time, my email got hacked, so I don't have access to my email, and I'm not sure what my broker has replied. I haven't called them. I'm just going to wait for that to resolve. But I'm expecting the worst. That is that my margin call didn't stop the losses. In fact, it went negative by 10 points. As you can see here, the balance is negative 10.50. So at the moment, I'm sort of trying to, I'm looking at the markets again. I've got a demo account, and I've got a new demo account as well, because the other demo account that I had since I started trading September 2012, that demo account basically is nearly empty. That's down to $68. It's a dollar denominated account, and I've had that since the beginning. So I was actually quite keen to rebuild it, and I did rebuild it to about more than half, because I had nearly blown it once. And I was doing the same with this live account, as you can see from the low here. I think the low here is not quite precise. I think I got to a low of about 78 or something like that. I mean, I rebuilt it gradually to that 332, and then started adding deposits, and then the equity drawdowns started increasing. As I didn't really increase the size of positions, just the as I said, the pip size started getting bigger and bigger. So I have a new demo account as well. This is in pounds through FXCM again. And I want to sort of start really having a go at these themes. Now, what I've learned from this is that I should have a stop loss. Because if the trades are not moving in my direction, at least I'm protected. And you could hedge things, but this has sort of shown me that if I had a stop loss, at least things wouldn't have got any worse. I would have lost some money, but kept the ability to trade. So at least for a while, I want to get back into using stop losses, because this has sort of dealt me a severe blow, and I didn't particularly think I needed a stop loss, because I thought I would manage these quite well. And sadly, maybe time would have shown me that I was right, or maybe that I was wrong, but I could have handled it successfully, regardless of having or not having a stop loss. Because what's happened this week is that the pound Kiwi sort of stalled just about where it was before, more or less. the Kiwi dollar position that I had open is actually come down to about nearly 0.70 and open at 0.69, so it's nearly a break even. The FTSE 100 and the S&P are sort of tagging lower a bit. The Euro Pound has come down to nearly 0.90 from a height of 0.91 and something. So in a way, the themes that I've been trading haven't changed that much since that Black Swan event on Thursday, Friday. And that makes me think that had I had a stop loss, I would be still trading those themes and maybe modifying my trades by adding stop losses after the fact on some of the other trades. Other things to reflect on as well is hedging. I could have put in a buy order for euro here or a sell order for pound Kiwi, and that would have basically hedged the trade, so one and the other kind of cancelling each other out. But I didn't think that the pound sell-off would continue. So in this particular event, had I done the sell, obviously that would have helped, but I still wasn't convinced that it was necessary. So I like to basically say that I haven't given up trading altogether. I'm thinking about it. I have one or two things up my sleeve. I've been talking to other people from the forum Baby Pips, which has helped. I've spoken to other people as well. I've not told many people. I've told my partner and my parents, and that's about it. And one other person, but I'm kind of keeping this quiet because it's bad enough as it is. But this video is to say to everybody on the forums and who's listening that these things happen. So after more than a year of holding some of these trades, it does hurt when you've spent so much time watching them and nurturing them, taking shorter term trades, kind of hedge them, capitalizing, shaping a whole way of thinking about long term holding through drawdown, etc. Sadly, I have to admit that it has hurt me a lot continuing in that fashion, because I should have really admitted that these trades were just wrong. And it really was a case of I should have cut them, or I should have hedged them, so gone short the pound and banked a lot of money, and then maybe either sort of cut the losing trades, having softened the blow, and or sort of in a way cushion the losses through the hedged positions, and then let those trades run eventually back to the upside in terms of the pound. But I didn't do that because I thought I had enough capital to withstand any fluctuations. Certainly something like this was of a scale that it just wasn't there wasn't enough capital to withstand that, and it was quite overstretched as in terms of the drawdown. So my drawdown was quite severe. This is sort of back in August. Okay, was that. So it was quite a lot in terms of if you put it in percentage. Yeah, it was kind of 90% drawdown. So it was quite a lot. And this kind of tells you that you can do one of two things. One is to give up altogether. I thought about giving up trading altogether. But it's like having a small injury when you're out running or riding or something, and if the injury isn't too severe, you can give up, or your mind will just kind of guide you to those old habits again. The dangerous thing about my mind at the moment is that it wants me to trade again, and it sort of wants to know what's happening in the markets, and that way sort of keeps me active in the themes. But at the same time, it's quite bad because it wants to trade in the old way, which is getting to those trades, the themes, long-term trades, no stop loss, and just watch the trades. I don't want to do that. What I want to do is to think about my entry a bit more, because I think where I entered before was in places was pretty not random, but it wasn't the best, and sometimes it was downright bad. Like the height of the pound Kiwi was pretty bad. This one here, this was pretty bad because I don't think I can see the. You can see the chart here, but yeah, there it is. So this is the trade. So essentially, yeah, I entered at the height here at 2.40, above 2.44, and then so the market just kept coming down and down, and I held from the height all the way down. So really, it was a really bad place to enter. It was the summer of last year. So what I want to do now is not to stop trading altogether. I want to continue trading. I had no capital. That was my trading capital. So thankfully I hadn't sort of relied on that for other things in my life. And in a way, I don't want to start putting capital in straight away. I want to wait and try to demo for a bit. The bad thing about that is that some of the themes that I've traded, which have not quite developed, may develop now. For example, the equities may suddenly decide to come down sharply. The S&P 500 from its heights, and the FTSE 100 as well from its heights. Something that I've been waiting for since 2015. So it's been nearly 2 years of me waiting for these cycles to conform, and you know, it hasn't quite gone that way. But if it happened now, tomorrow, the next month, I say not going to have enough capital to trade those for the foreseeable future. And should I decide to capitalize, I may just have to trade one thing, okay, take just one trade, and then I may get stopped out because I want to start using stops. So I think what I'll do is I will use a demo account and get a few months of results, and then start deciding if I am ready again. Perhaps do some trading contests that are free, so I'm not losing anything, I'm not gaining anything. But if they offer a prize or a reward, that might be a good incentive to try maybe shorter term trading and sort of be familiar with that again. Certainly that's my plan at the moment. I don't want to give up trading altogether. I want to stay involved in some kind of way, even just from the periphery, watching the markets and knowing what price is doing, what the fundamentals are, and maybe follow less things, maybe just have one theme, maybe just the Kiwi, or maybe just risk on, risk off. Certainly I think currencies are my thing, because equities have not really played ball with my kind of thematic approach. I think I understand fundamentals in currencies a bit better than in equities. Indices are quite difficult to understand, because not only are they moving as one, but all the companies within that index have different needs and different prompts, and their motivations are not always converging. So within the FTSE you might have some drivers like gold mining or tech companies, or pharmaceuticals or oil companies, and if there's an oil crash, it will drive the index down, as it has done. But you know, other companies might do well, so that will obviously reduce the impact. If the index is traded algorithmically and things start kind of collapsing because of a risk-off kind of scenario, then fine, then it will move in one direction. But I've been waiting for nearly 2 years for that to happen, and it hasn't. So obviously the environment is not ready for a risk-off kind of scenario, and so that's quite a difficult kind of one-off trade of the century. I realized that I was putting too much weight on that, although trading small, but still I was 1,000 pips pretty much in drawdown on that sort of hope that it would come back. Okay, so I think I've said enough, but basically I will stay tuned and trade demo for a bit and see what happens, and try to use stop losses, not necessarily targets or profits. Maybe let the targets be open and then move the stop loss to a trading stop or a break even if the trade starts moving in my favor. But certainly put a stop loss and decide how much I'm willing to risk on each trade, and based on the account size. So that I need to really work on, and that will be enough for now. That's all I want to do, just have a more rigorous approach to risk management. Because in the past, when I needed to build this account before, I was trading too many big trades, maybe for a few points, not scalping, but shorter term trades, and I over leveraged. This time I wasn't over leveraging in the size of the trades. I was trading £1,000 per trade, so the positions are quite small. But then obviously the lack of stop loss or any kind of cutting off point meant that the size of the drawdown was increasing more and more. So I was over leveraged in a different way, but still over leveraged. So I've seen both sides of the over leveraging, the position size error and the drawdown size error. So I've now really been told by the markets twice in 2 years that I need to mend my ways, and that is what I intend to do. So thank you very much for listening. I hope this has been a useful video for you as well. If you've been in this situation before, you probably know how it feels, but also if you haven't been in a situation and you followed me before, this is kind of where I am at the moment. I hope it's kind of something that you might recognize in your own trading or not. Please subscribe and leave comments. I appreciate it. Thank you very much. I'll see you in my next FreeFX video. Cheers.